December 2025, 4 trading days. 47.6 million ounces of silver claimed for physical delivery from COMEX vaults. That's more than 60% of the entire registered silver inventory. Gone in less than a week. This isn't normal market activity. This is a structural breakdown happening in real time, and most people have no idea it's even occurring. Let me show you exactly what's happening inside COMEX vaults right now, why this is different from every other delivery surge in the past 40 years, what the math says about how long the system can survive at this pace, and why the next 60 to 90 days could determine whether COMEX defaults on physical delivery obligations for the first time in its history. Because this isn't about silver going up or down. This is about whether the paper silver market can continue functioning when physical demand exceeds what the vaults can actually deliver. And right now, the answer is becoming increasingly clear. It can't. Before I show you the emergency unfolding in December, you need to understand how COMEX actually works. Because the system most people think exists and the system that actually exists are two very different things. COMEX is the commodity exchange. It's where silver futures contracts trade. Each contract represents 5,000 troy ounces of silver. Traders buy and sell these contracts every day. Billions of dollars in notional value change hands. But here's what matters. Less than 2% of futures contracts historically result in physical delivery. The other 98% get cash settled or rolled forward into the next contract month. This is normal. This is how the system is designed to work. The futures market exists primarily for price discovery and hedging, not physical delivery. Manufacturers hedge their silver needs. Miners hedge their production. Speculators bet on price direction. And most of it settles in cash. But the system only works if physical delivery remains possible for those who want it. Because if you can't get physical silver when you demand it, the futures price becomes meaningless. It's just a number on a screen with no connection to reality. This is where COMEX vaults come in. There are two categories of silver in COMEX-approved warehouses, eligible and registered. Eligible silver is metal stored in COMEX-approved facilities. It meets purity standards, it's in the vault. But it's not available for delivery against futures contracts. Think of it as silver that's just being stored there. The owner hasn't made it available for delivery. Registered silver is different. This is metal that has a warrant attached. It's specifically earmarked as available for delivery against maturing futures contracts. When someone stands for delivery, demanding physical silver instead of cash settlement, it comes from registered inventory. This distinction matters because only registered silver can satisfy delivery demand, and registered silver has been falling for years. In February 2021, registered silver at COMEX peaked at 152 million ounces. By summer 2023, it had fallen to 30 million ounces. That's an 80% decline in just over 2 years. Throughout 2024, registered silver fluctuated between 30 million and 75 million ounces. The average was around 50 million. The system was functioning. Delivery demand was being met. Everything appeared normal. Then, December 2025 arrived. In the first 4 trading days of December, 7,330 silver futures contracts demanded physical delivery. That's 36.65 million ounces. In 4 days, the total registered silver inventory at the start of December was approximately 75 million ounces. So in 4 days, 49% of available registered inventory was claimed. But the real number is worse, because during those same 4 days, some silver was added to registered status from eligible. Without those additions, the percentage claimed would have exceeded 60%. Let me put this in perspective. In the entire calendar year of 2023, COMEX saw 23,114 silver contracts delivered. That's the full year. December 2025 saw delivery demand exceed 7,000 contracts in 4 days. At this pace, December alone could surpass entire years from the recent past. And this isn't a one-month anomaly. November 2024 through March 2025 saw sustained elevated delivery demand. Over 32,000 contracts delivered in just 4 months. The entire year of 2023 was 23,400. Something fundamental has changed. Physical demand is surging, and the vaults are responding by draining. Now let me show you what's happening simultaneously in other silver markets around the world, because COMEX isn't the only vault under pressure. Shanghai silver vaults in China recorded their largest weekly outflow ever in early 2025, 257 tons withdrawn in a single week. Total Shanghai inventories fell to 663 tons, the lowest level in 21 months. That's a 43% decline in just 2 weeks. For 14 consecutive trading days in early 2025, COMEX saw net outflows every single day. 33.9 million ounces left the vaults during that period. No breaks, no pauses, just continuous drainage. But here's what should concern you most. Despite these massive outflows, COMEX has been receiving large inflows simultaneously. Between March 10th and March 27th, 2025, COMEX received 48.7 million ounces of silver into the vaults in just 14 business days. Over those same 14 days, 6.6 million ounces left. Net change, positive 42 million ounces, added to total inventory. This tells you something critical. The banks that manage COMEX vaults are scrambling to replenish inventory because they expect delivery demand to continue. They're importing silver aggressively. They're converting eligible to registered. They're doing everything possible to maintain the appearance that the system can handle delivery requests. But it's not working fast enough. Because even with these emergency inflows, registered silver keeps getting claimed faster than it can be replenished. The London Bullion Market Association, the other major silver trading hub, is experiencing similar stress. Delivery times have extended from the normal 1 to 2 days to 8 weeks. 8 weeks. The LBMA claims this is due to shortage of manpower and trucks, but delivery delays don't happen in a well-supplied market. They happen when there isn't enough physical metal to deliver on demand. London silver inventories fell to 827 million ounces in December 2024, near all-time lows. Of that, 551 million ounces is reportedly allocated to silver ETFs like SLV. That leaves only 276 million ounces of free float. And even that number is opaque. No one knows how much of it is actually available under stress conditions. The global silver market is tightening simultaneously. COMEX draining, Shanghai draining, London delaying deliveries. This isn't isolated stress, this is systemic. Now let me show you the math that explains why this is unsustainable and why default risk is no longer theoretical. As of early December 2025, COMEX registered silver sits at approximately 73 million ounces. But open interest in silver futures is massive. There are currently over 140,000 contracts open. Each contract is 5,000 ounces. That's 700 million ounces of silver in paper contracts. The ratio of paper claims to physical registered silver is 9.5 to 1. For every ounce of silver actually available for delivery, there are 9.5 paper claims against it. This works fine when only 1% to 2% of contracts stand for delivery. But what happens when 5% demand physical? Or 10%? If just 5% of current open interest demands delivery, that's 35 million ounces, nearly half of registered inventory. If 10% demand delivery, that's 70 million ounces. Our registered inventory would be wiped out completely, and we're already seeing delivery rates far higher than historical norms. December's first 4 days saw delivery demand that, if sustained for the full month, would exceed 50,000 ounces claimed. That's a 7% to the paper to physical ratio demanding real metal. The system is designed to handle 1% to 2%. It's currently experiencing 7%, and the trend is accelerating, not slowing. But there's another number that matters even more. The drain rate. At the pace of the first 4 days of December, COMEX registered silver is being claimed at a rate of 12 million ounces per day. At that rate, the entire 73 million ounces of registered silver would be gone in 6 days. 6 days. Now, that pace won't be constant. Delivery demand fluctuates. But even if we assume a more conservative drain rate of 5 million ounces per day, registered inventory is exhausted in 15 days. And here's the problem. Replenishing registered silver takes time. You can't just magically create it. You need to import physical silver, transport it to approved warehouses, assay it to verify purity, and convert it to deliverable bars with proper warrants attached. This process takes weeks, sometimes months. And if multiple parties are demanding delivery simultaneously, competing for the same limited physical supply, the replenishment rate can't keep up with the drain rate. This is the mathematical reality COMEX faces right now. Drain exceeds replenishment. And when that happens, you're not managing inventory. You're counting down to zero. Now let me show you what's driving this unprecedented physical demand, because understanding the why tells you whether this is temporary or structural. And the answer should terrify you. It's structural. First, industrial demand is exploding. Silver is required for solar panels, electric vehicles, semiconductors, 5G infrastructure, and AI data centers. Every single one of these sectors is growing rapidly. In 2024, industrial silver consumption hit a record 680.5 million ounces. That's up 11% from 2023. And 2025 projections show industrial demand exceeding 700 million ounces for the first time in history. Solar panel production alone consumed approximately 200 million ounces in 2024. Each photovoltaic panel requires 15 to 25 grams of silver paste for conductivity, and global solar installations are doubling. The International Energy Agency reports that by 2030, solar could require 300 million ounces of silver annually. Just solar, just one sector. Electric vehicles use 25 to 50 grams of silver per vehicle, roughly double what internal combustion engines require. Global EV production is projected to hit 20 million units in 2025. That's 600 metric tons of silver demand just from cars. And this is growing at 30% to 40% annually. Add in AI data centers requiring massive electrical infrastructure, 5G networks rolling out globally, and semiconductor production recovering from supply chain disruptions. And you have industrial demand that structurally exceeds mine supply. The Silver Institute reports that 2024 saw a supply deficit of 282 million ounces. Demand was approximately 1.3 billion ounces. Supply was just over 1 billion ounces. That's the fourth consecutive year of deficit. Cumulative deficits from 2021 to 2024 total 678 million ounces. That's 10 months of global mine production. Gone. Consumed. Not replaced. Where did that 678 million ounces come from? Above ground stockpiles, vaults, reserves, COMEX, London, Shanghai, ETFs. The physical silver that was supposed to back the paper market is being drawn down to meet industrial demand. This is why vaults are draining. Industrial users need real metal. They can't build solar panels with paper contracts. They can't manufacture EVs with futures promises. They need physical silver. And they're going to the markets where physical silver is supposedly stored. COMEX, London, Shanghai. And they're demanding delivery. Second, investment demand is surging. After years of selling, silver ETFs saw net inflows of 95 million ounces in the first half of 2025. Total global ETF holdings reached 1.13 billion ounces, just 7% below all-time highs. Investors are buying physical silver because they see the same deficit math that industrial users see. Supply is shrinking, demand is growing, and anyone paying attention realizes that physical silver is undervalued relative to the paper price. When you combine exploding industrial demand with rising investment demand, you get a physical squeeze. Not a speculative squeeze like the Hunt brothers in 1980, a structural squeeze driven by genuine scarcity. Third, geopolitics is accelerating the drain. China announced export restrictions on silver effective January 2026. Russia has been hoarding metals as part of de-dollarization efforts. Sovereign wealth funds and central banks are diversifying reserves into hard assets, including silver. This isn't retail investors buying coins. This is nation-states securing strategic resources. And when countries decide they want physical silver, they don't care about price, they care about availability. The perfect storm. Industrial demand at records, investment demand rebounding, geopolitical hoarding beginning, and all of it converging on vaults that were never designed to handle this level of physical delivery stress. Now let me show you what happens if COMEX runs out of registered silver, because this isn't theoretical anymore. This is a scenario that needs to be considered seriously. If registered silver is depleted faster than it can be replenished, COMEX faces three options. None of them are good. Option 1, force cash settlement. COMEX could change the rules and require cash settlement instead of physical delivery. They've done this before in other commodities. In March 2022, the London Metal Exchange suspended nickel trading when prices spiked from $25,000 per ton to over $100,000 in hours. They canceled trades and forced cash settlements. If COMEX forces cash settlement in silver, it means the futures contract is no longer tied to physical metal. It becomes a pure financial instrument with no connection to the underlying commodity. But here's the problem. Industrial users need physical silver. A manufacturer building solar panels can't use cash to create conductive paste. If COMEX can't deliver physical metal, manufacturers will source it elsewhere. They'll go directly to miners. They'll buy from refiners. They'll import from international markets. And the price they pay in these physical markets will diverge from the COMEX futures price. You'll have two silver markets, a paper market trading on COMEX with forced cash settlement, and a physical market where real metal trades at whatever price is necessary to secure supply. This is the death of price discovery. The whole point of COMEX is to provide a transparent market-based price for silver. If that price no longer reflects physical availability, the exchange becomes irrelevant. Option 2, source silver from eligible inventory or external sources. COMEX could convert more eligible silver to registered status. They could import silver aggressively from international markets. They could pay whatever premium is necessary to bring physical metal into the vaults. This is what they're doing right now. Those 48 million ounces that flooded into COMEX vaults in March 2025, that's emergency sourcing. But this strategy only works if there's enough available silver globally to import, and every indication suggests that global supply is tight. London inventories at near all-time lows. Shanghai drained by 43% in 2 weeks. If COMEX is competing with London, Shanghai, and direct industrial buyers for the same shrinking pool of physical silver, prices spike. Premiums explode. And eventually, even at elevated prices, there isn't enough supply to meet demand. Option 3, ration deliveries and extend timelines. COMEX could implement allocation systems. Instead of delivering on demand, they could extend delivery windows. Instead of settling contracts within days, they could push timelines to weeks or months. This is what the LBMA has done. 8-week delivery delays. But rationing and delays erode confidence. If traders know they can't get physical silver when they demand it, they stop trusting the system. They demand delivery earlier. They hoard physical. They avoid the futures market entirely. Rationing accelerates the very problem it's trying to solve. It signals scarcity, which increases hoarding, which increases physical demand, which drains vaults faster. All three options are bad. Cash settlement kills price discovery. Aggressive sourcing spikes prices and may not find enough supply. Rationing erodes confidence and accelerates hoarding. And the worst part, once confidence in the system breaks, it doesn't come back. If COMEX defaults even once, if they fail to deliver physical silver against maturing contracts, trust is gone. Traders will demand physical preemptively. The paper to physical ratio collapses, and the system enters a death spiral. Now let me show you the timeline. Because based on current drain rates, delivery demand trends, and global inventory levels, we can estimate when the stress becomes critical. December 2025 registered inventory is approximately 73 million ounces. If delivery demand continues at the rate of the first 4 days, registered silver could be depleted by end of December. More conservatively, if delivery demand averages 20,000 contracts per month, that's 100 million ounces over the next 5 months. Even with aggressive replenishment efforts, registered inventory would struggle to stay above 30 million ounces, the level many analysts consider the floor. If registered inventory falls below 30 million ounces and delivery demand remains elevated, COMEX enters crisis mode. Every additional delivery request becomes a potential default. Every contract maturity becomes a stress test. My estimate, based on current data, January through March 2026 is the critical window. If delivery demand stays elevated through Q1 2026, COMEX faces its first genuine delivery crisis since the exchange was founded. This isn't fear-mongering, this is math. Drain rate exceeds replenishment rate. Open interest remains massive. Industrial demand is structural, not cyclical, and global inventories are at multi-year lows. The system is fragile. One shock, one large buyer demanding immediate delivery, one geopolitical event causing a rush to physical could be the trigger that breaks it. What does this mean for you? Whether you hold silver, trade silver futures, or have no position at all, what's happening at COMEX matters. Because if the paper silver market breaks, the entire commodities complex gets repriced. If you hold physical silver, coins, bars, bullion, you're positioned for exactly this scenario. Physical silver in your possession has zero counterparty risk. If COMEX defaults, if paper markets freeze, physical holders are protected. But understand this, premiums on physical silver are already elevated. Dealers are paying $5 to $8 over spot for generic rounds. American Silver Eagles trade at $8 to $10 premiums, and these premiums are rising as supply tightens. If COMEX stress accelerates, those premiums could double or triple. Physical silver could trade at $50, $60, $70 per ounce, while COMEX futures trade at $35 because the paper market has disconnected from physical reality. Physical holders win in that scenario, but only if they already own the metal. Trying to buy physical during a crisis means paying massive premiums or finding that dealers are sold out entirely. If you hold paper silver, ETFs, futures, certificates, you have counterparty risk. Your silver is a claim on someone else's inventory. If that inventory doesn't exist, if the entity backing your paper can't deliver physical, your claim becomes worthless or gets cash settled at a price that doesn't reflect physical market reality. The lesson from every commodity squeeze in history is the same. Physical beats paper. When scarcity hits, promises evaporate. Only tangible assets survive. If you trade silver futures, understand that the rules can change mid-game. COMEX has the authority to force cash settlement, change margin requirements, or suspend trading. If you're long futures expecting to take physical delivery, you might not get it. If you're short futures, you might face margin calls as prices spike before settlement rules change. Trading paper silver right now is like playing poker when you know the dealer can change the rules to protect the house. You might win. But if the house faces losses, the rules change, and your position gets closed at whatever price protects the system, not you. And if you're watching from the sidelines, understand that what happens in silver affects everything. Gold, platinum, palladium, copper, nickel. Every metal traded on exchanges with paper to physical mismatches faces similar risks. If COMEX silver defaults, it sends a signal to every commodity market that paper promises can't be trusted. Physical demand surges across all metals. Premiums spike. And the financialization of commodity markets, the idea that you can trade paper contracts infinitely larger than physical supply, dies. Now, before I show you where this is all heading, let me remind you that this isn't financial advice. I'm not telling you what to do with your money. I'm showing you the data, explaining the mechanisms, and laying out what the math suggests happens next. You need to make your own decisions. Talk to financial advisors. Understand your risk tolerance. But make those decisions with full knowledge of what's happening inside COMEX vaults right now. Because most people don't know. Most investors think COMEX is functioning normally. Most traders assume physical delivery is always available. And most analysts dismiss the idea that a major commodities exchange could default. They're wrong. The data proves they're wrong. And the next 60 to 90 days will determine whether the silver market enters a new paradigm where paper and physical prices diverge permanently, whether COMEX can stabilize the situation by sourcing enough physical silver to meet delivery demand. My view, based on everything I've shown you, the odds favor disruption. The drain rate is too high, the replenishment rate is too slow, industrial demand is too structural, and global inventories are too depleted. COMEX might survive the next few months. They might successfully source enough silver to avoid outright default. But the cost will be higher prices, wider premiums, and permanent damage to confidence in paper silver markets. And if they can't source enough silver, if delivery demand exceeds their ability to deliver, we're watching the beginning of a default scenario that reshapes commodity markets for the next decade. Let me end with a historical perspective, because what's happening in silver right now has happened before. Just not in silver, and never at this scale. In 1980, the Hunt brothers attempted to corner the silver market. They accumulated 200 million ounces, roughly one-third of U.S. supply. Silver spiked from $6 per ounce to $49 in 18 months. Then COMEX changed the rules. They banned new long positions and forced liquidation only. The Hunt brothers were destroyed. Silver crashed. The squeeze was real. The shortage was real. The $49 price was real. The exchange intervened, changed the rules, and killed the squeeze to prevent default. Could COMEX do that again? Yes. But there's a difference. The Hunt brothers were speculators. Current delivery demand is driven by industrial users who need real metal for production. You can force speculators to liquidate. You can't force Toyota to stop building electric vehicles. You can't force solar manufacturers to stop installing panels. The demand is structural. And structural demand can't be legislated away by changing exchange rules. In March 2020, gold futures experienced extreme stress. COMEX gold traded at a 3% discount to London spot prices because there wasn't enough gold in New York vaults to deliver against maturing contracts. The spread between paper and physical exploded. Refiners airlifted gold from London to New York to prevent default. The system survived. But it required emergency intervention, premium payments to secure physical supply, and it exposed the fragility of futures markets when physical delivery is actually demanded. Silver in 2025 is following the same pattern, except the scale is larger, the drain rate is faster, and the global supply situation is tighter. History shows that exchanges will do whatever necessary to avoid default. They'll change rules. They'll source metal at any price. They'll extend timelines. But history also shows that these interventions come at a cost. Trust erodes. Premiums spike. And eventually, the paper market becomes irrelevant as participants demand physical settlement. We're watching that process unfold right now. The question isn't whether COMEX will defend the system. They will. The question is whether the defense succeeds or whether physical scarcity overwhelms their ability to deliver. And based on the last 4 days of December 2025, based on the math of drain rates versus replenishment rates, based on the structural nature of industrial demand, the answer is becoming clear. The system is breaking. Not broken yet, but breaking. And the cracks are visible for anyone paying attention. 47.6 million ounces claimed in 4 days, 60% of registered inventory, sustained outflows for 14 consecutive days, global inventories at multi-year lows, industrial demand at all-time highs, supply deficits in their 4th consecutive year. This is the setup for default. Not guaranteed, not tomorrow, but possible. And far more likely than at any point in the past 40 years. The COMEX vault emergency is real. The math is undeniable. And the timeline is measured in weeks and months, not years. What you do with this information is up to you, but you can't say you weren't warned. And if you want to understand how this same pattern has played out throughout history, how nations have learned the hardest lessons about the difference between money and wealth, you need to watch my documentary on the empire, Killed by Silver. Spain controlled more silver than any nation in history. They mined it from Potosi, the richest mountain on earth. They flooded the world with it. They thought they were rich. And they went bankrupt, repeatedly. Because silver isn't wealth, production is wealth. And when you confuse the two, when you think that controlling money means controlling prosperity, you destroy your economy from within. Spain's mistake with silver in the 1500s is playing out again today in reverse. Except this time, it's not too much silver causing the crisis. It's too little. And the nations that understand the difference between paper promises and physical resources are the ones positioning for what comes next. Check out that documentary. The empire killed by silver, Spain's $10 trillion mistake. Because the lessons from 400 years ago are playing out right now in COMEX vaults, and understanding history is the only way to position for what's coming. The silver vault emergency is here. Default risk is real. And the next 60 to 90 days determine whether the paper silver market survives or whether we enter a new era where physical and paper prices diverge permanently. The countdown has begun, and every day that passes with elevated delivery demand brings COMEX one step closer to the crisis that everyone thought was impossible. Until it wasn't.